Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending May 15th, 2020. This is a daily chart, the S&P 500. I want to point out this range here. It's like a lateral range, about 5% between here, and this is 5 weeks, so each one of these boxes is 1 week. So I'm going to take this chart back on an intraday chart, show you where we left off as of last weekend's video. So we got initial breakout of this range, what I call the dash for trash. A lot of weak stocks, weak balance sheet stocks led this rally. Then a breakdown back into the range, and it looked like maybe it was a head fake or a bull trap up here. So this is how we left off last week. The S&P had this it started off as kind of like a flag over here, but then ended up more as a rising wedge. Here's the Dow transports. You can see they had more of something like a flag. Like here's the breakdown, here's the flag. But last week, the NASDAQ 100 really led the market. It was pretty much solely responsible for the gains, and you can see it's up in a rising wedge. That's why the S&P 500 started off as kind of a flag like transports and ended up more as a wedge towards the end of the week. And more to the point, it was like a handful of stocks, 5 or 6 stocks, really heavily weighted mega caps, or the FANGs, or the MAGA stocks, whatever you want to call them: Facebook, Amazon, Apple, Microsoft, Google. And as I also touched on in recent weeks, we're seeing more retail traders jumping into the market. So this is the total number of stock positions at Robinhood. So here is the COVID-19 lockdown. Here's an explosion in, kind of retail traders or Robinhood guys buying stocks. This is kind of a bearish pattern. It has a bearish bias to it. Generally, when it comes to an apex and they break down, wedges retrace their base. So, somewhere down in here, or kind of this 8,900 is a pretty good support level. You may recall from the last video that I showed this 3C chart. This is the wedge over in this area. And 3C kind of showed some good buying early in the week at the start of the wedge. And then as prices kind of gone up, 3C was negatively diverging. So it was showing either weaker hands or distribution into rising prices. So that's kind of how we left off last week. And although it looks a little different, the theme is the same here for the SPY. So here's small caps. And I've been trying to build a short position for about 3 or so weeks up in this area, right around this 126 area, which is the 2018 low. Idea behind that is there's a lot of overhead supply above that level. So I added some over here, and last Friday, as it closed at the high of the day into the end of the week, I added the rest of my short position in small caps, also a negatively divergent 3C signal there. So let's roll into this week. And as you can see, prices broke down in kind of a typical 2-leg. First leg down here, this is that major support area for the S&P, the top of the range, around 2863. A little teeny bear flag there, and then the next day, another leg down. That's typically how it happens. One leg, little bear flag, second leg. So we did get to a really deep oversold, one-day oversold level here, and I thought we would kind of get a bounce or consolidation into this trend line, kind of back test it the rest of the week. That's what happened. It came on some speculation on Twitter that there would be a merger between Wells Fargo and Goldman Sachs. It was just bunk speculation, but it was enough, that one-day oversold condition. So S&P ended the week down 2.25%. That's the worst weekly performance for the S&P since the week of the 20th, March 20th, which was the last week of the crash. Here's the NASDAQ 100, broke this ascending wedge. One leg, little consolidation, like a bearish flag, second leg, but it did hold at this major support level, or what I would consider like the top of its range, around 8,900, bounced from that. So down about 0.75% on the week for the NASDAQ 100. Here's the Dow 30, so here's the breakdown, and it lost about 2.65%. Broke down below the bottom end of that range, that big 5-week range, and then kind of bounced back into it. So didn't backtest all the way up here like the S&P did. The way I view this decline is as a second leg of this decline. So this is where I thought we would have the head fake, if you recall that. So here is the first leg. Here is the consolidation. We had some flags like in Dow Transports or IWM, and here is a second leg. Now, Dow did bounce off a technical level right here at 23,100 and also 23,000 and its 50-day moving average right here. IWM did the same at its 50-day moving average. There's the sell-off, and here is the bounce into the end of the week. And here's the intraday chart of IWM. So this is what I would consider the head fake or the failed breakout, bull trap. First leg, consolidation like a flag, second leg, and it breaks a pretty decent trend over here. Back test into this 126 area. So this is where I added the rest of my short, filled out the short position right there. So the theme is we have the S&P and the small caps all backtesting into this important level that's been there. It's kind of defined this range, the top end of the range, for 5 weeks. NASDAQ, on the other hand, bounced off of it, so it's above it still. So it's more constructive for one reason, because it held that level as support. But just from a price aspect, it is making higher highs and higher lows, okay? So even on this pullback, that is still a higher low. Now contrast that with small caps. It is making lower highs and lower lows. So that's why I say NASDAQ is in a little better technical position. But as far as this range goes, Dow transports are in the worst position. They're down almost 7% on the week. And again, you can see that first sell-off, kind of bearish flag consolidation. Not a great bearish flag, but it's the same in concept. And second leg down, but breaks below the bottom of the range and backtests into it at the end of the week. So instead of being up here like the S&P or small caps IWM, it is down here and below. And the sub-intermediate price trend is making lower highs and lower lows. Whatever we have here so far, that's a lower high. I mentioned transports because transports tend to lead the Dow the same way small caps tend to lead the broader market, or semiconductors tend to lead the technology sector. As far as the bounce over here, this was like a really oversold, one-day oversold condition from internals. So this is a 5-minute chart of the NASDAQ 100 and a 13-week new high, new low ratio. So let's just say under 30 is oversold. So this is where we were, the most oversold we've been since basically the first week of the rally. So this was where we were as of Wednesday, very, very oversold. So what Thursday and Friday's bounce or consolidation did was relieve that deep oversold condition. I never enter a new short when we're this oversold on these kind of breadth oscillators. There's a pretty broad-based decline on the week, so there was only one of 11 sectors that actually closed green. That was healthcare sector. It was up 1%. And the second best performing on a relative basis was the defensive consumer staples, only down 1.3%. Conversely, the worst performing was energy, and here it is down 7.2%. So it fell out of this uptrend over here. You can see this uptrend broke below this level of support, about 36.50, and backtested into it. The industrial sector down 5.8%. Again, you can see that same kind of two-leg, first leg down after a failed breakout over here, or bull trap, kind of a flag, and then another breakdown. So like transports, it's below the range and backtesting into it at the end of the week. The financial sector lost 5.5%. Very suspect sector because it never broke out over here like the others. So it did break down this week though. This is like a big, large consolidation. There it is. So this is the breakdown this week. This is kind of more suspect than most of the other sectors. And you might recall from last weekend's video, I said the most significant thing that happened was the banking index, the KBW banking index, broke down. So this is how it broke down last week. This is this week, so it added more to it. Let me show you what this big pattern looks like. This is kind of like a very big bear flag. This is the March 23rd low. This is where the entire market has rallied from since. This is a breakdown under that flag. Here's where we ended last week. Broke down more this week, so lost another 9.75% this week. And this week, I think one of the more interesting developments or important developments is the regional banks. They were still in a similar big bear flag. They broke down this week over here. So you can see regional banks broke down, and they're following in the footsteps of that KBW bank index with this kind of bear flag breaking down, which looks almost identical to IWM. And here's IWM with that same kind of big bear flag, and breaking just below it this week before closing back above Thursday and Friday. So you can see the banking index, the regional banks are leading small caps lower, and small caps even dip below. Transport, same kind of thing. So this is why I'm saying, a lot of these sectors that are indexes that are really sensitive and tend to lead the broader market, like transports lead the Dow or small caps lead the broader market, are showing some real ugly signs and breaking below some levels that are pretty significant. And getting back to these banks real quick, there was a stock in particular that I featured last week, and I said, this looks horrible. This is not what you should see at a market bottom. That stock was Wells Fargo. So last week, it had just started breaking down of a similar pattern or similar kind of flag, and this week, it lost another 8%. Here it is on a daily chart, What I was saying last weekend was this looks like a big bear flag, and this looks like the second leg starting, the second leg down. And last weekend we were talking about the Robinhood group. We're buying the airlines, we're buying the cruise lines. They thought they were a deal. And over the weekend, last weekend, Warren Buffett had announced that he sold his airlines. He sold all of them at that point. Well, as the banks, Wells Fargo was just getting destroyed this week, it came out that Buffett was not buying stocks like everybody expected. Blood in the streets, Buffett's got to be buying. No, he was selling, and what he was selling on Monday was U.S. Bancorp. He sold out of his entire position, and then on Friday it came out that he sold 84% of his Goldman Sachs position as well. So when we see the banks acting this bad, I said to somebody on Twitter, they said, oh, that must be Buffett selling. Or they said, that must be Buffett getting ready to sell. And I said, no, that's probably Buffett selling. Either way, it's not here nor there, but as you saw, the banks and small caps started to break this kind of similar flag type pattern, and you have a stock like Wells Fargo that is already starting the second leg down. That's a really ugly chart. You should not see something like that at a market bottom. Okay, and 2 weeks ago, I said we have a new risk on the horizon. At least that's what the FX market, the currency market, was pointing out. What I showed about 2 weeks ago was this dollar-yuan pair. Okay, this is a 4-hour chart. And just to orient you, so you know kind of what this means, when it's going up like this is bad for risk assets. As a matter of fact, this high right here, that is the bear market bottom, the crash, the March crash low. This pullback ever since has been the period that stocks have rallied from that March low, March 23rd, right down here. So a couple weeks ago, when it started to break out of this big flag again, I said that is trouble. That is trouble specifically with China. And at that time, we were just hearing, the president of the United States talking about, kind of China was to blame for the coronavirus and all that. And okay, well, maybe that's what it is. Consolidated in a flag this week started to break out of that flag again. I kept telling my members, if it breaks above 712, that means we're getting into a more risky situation. If it breaks above 716, 717, we're in full-on risk-off mode. So here it is about midweek, breaking out of this more recent small bullish flag, which is bearish for risk assets, bearish for stocks if it breaks out. Here's that 712 level. So what happened this week? 1, President Trump blocked the Federal Retirement Fund from investing in Chinese stocks, which sent the Chinese into a tizzy. They were not happy about that. 2, Trump blocked shipment of U.S. semiconductors to Huawei. And 3, he gave an interview on Fox News and said all kinds of things. He doesn't want to talk to Xi on the phone, and that we could cut off the whole relationship with them. If we did, what would happen? We'd save $550 billion, which I don't know if that was a reference to the trade deficit or if that was a reference to like canceling the debt that we owe them, the U.S. Treasuries. I don't know, but either way, USDCNH broke out over here. The same day, something else happened. Last week, I showed you the charts of gold and silver looking very bullish, consolidating. The same day this broke out, so did gold. This was the bullish consolidation I was showing last week. Here is the breakout for GLD. I also showed silver, SLV. It had come out of this bullish descending wedge and then a bullish consolidation here. There's the breakout this week. So big move for silver, nice move for gold. Both those happening as the tensions between the US and China ratcheted up. Okay, so my view is that this is a bear market rally. That hasn't changed. I've shown some pretty spectacular bear market rallies like 1929. We had one way bigger than this. It went for 5 months and it gained 50%. So way bigger, way longer than this. But typically, I've seen quite a few actually that retrace up to the 61.8 Fibonacci level. That's the 61.8 or 5/8 of this crash. Taking you back in history, this is the S&P 500 at its all-time record high in October of 2007, going into the financial crisis. And the initial decline, the counter trend rally up to the 61.8 fib level. Here's the NASDAQ 100 at the bull market tech bubble high. The initial decline, the first counter trend rally, 61.8 5/8 retracement. In any case, that doesn't mean it is, it doesn't mean it isn't. It just means that it is consistent with bear market rallies, historically speaking. Heading into next week, we have this kind of dichotomy of relative performance. So the NASDAQ rising wedge broke, didn't quite retrace to the base because there's a pretty significant support level here at 8,900. But the point I'm trying to make is that it is in better technical shape, higher highs, higher lows, also above the top end of what I'm just defining as that 5-week range. The S&P 500 is in that 5-week range, back testing into the top of it. The Dow Industrials back into that range, broke below, got back in, not retesting to the top. Anyway, a little bit worse position here, technically speaking. And then the Dow transports. So they broke into the range, broke down below the range, back tested into that the bottom of the range there. So they're in the worst position. NASDAQ is up here above it. S&P and Dow are down here. And transports, which tend to lead the Dow, are down here below it. So we have that same kind of theme going on with S&P sectors. The technology sector, a rising wedge, bearish rising wedge that broke down but held along this trend line right over here. And then on the other side of the spectrum, the banks that just completely broke down out of a major price pattern. It looks like it could be a bearish flag. And then you've got stocks, like WFC, Wells Fargo, that not only broke down but made a new 9-year low. There's others like General Electric here, same thing, making new lows. The airline stocks that the retail traders tried to buy back over here broke down, making new lows. And here's what that looks like on a daily chart. So this to me looks like a bearish pennant, and this to me looks like a second leg down. Here's first leg, here's second leg. That's what we're seeing in Wells Fargo. That's what we're seeing in GE. And that's what we're seeing the bank index heading toward. One thing I want to point out real quick is VVIX, the volatility of VIX. So this is how it acted when the market was crashing. So from March 23rd, as the market's been rallying, it's been pulling back. This is this past week. So to me, this is a major inflection point as far as what volatility or VVIX is saying about the future. It's telling me something has changed here. Quite obviously, the trend has changed. And as if a global pandemic wasn't enough for the market to worry about, now we have a trade war part two on the horizon, and that is reflected right here by USD CNH, the dollar Yuan. Right over here at the end of March, that was max risk off. Okay, so this is what it's done in the past couple of weeks. First, saw some risk, kind of pulled back on it, and then this week, moving up towards that risk again. And remember what I said, gold broke out at the very same time that this broke out from this little bullish flag over here, which is bearish for risk assets. Gold actually broke out 2 days before the market sold off, crashed into February, March. Some of you who've been watching my videos, you may recall this if you've been watching for a couple months. I put out a video specifically on this. Gold was consolidating, like recently, in a bullish consolidation. This is an ascending triangle. It's bullish. It's building up power to break out. And watch what happens here. This is the end of February. And let me walk this forward. There we go. That is February 18th. Gold breaks out. February 18th. Let me show you the S&P 500. Here's the S&P 500, February 18th, near all-time record highs. Nobody's paying attention to what's going on. There it goes. Gold broke out 2 days ahead of time. Boom, there's the crash. Is gold sending us a similar signal right now? That's up to you to judge. I'm just saying this broke out at the same time that the currency pairs were saying risk, trouble ahead, risk off. U.S.-China tensions flaring up. I think the risk over the weekend is that China retaliates against the U.S. We'll see what happens with that. So on that happy note, let's wrap up this video. Thanks a lot, everybody, for watching. If you enjoyed it, please give it a thumbs up. I appreciate it very much. And if you have questions or comments, please go ahead and leave them in the comment section below. I try to get to all of them. Check out the website. Check out the content over there. You can subscribe for free content when it comes out, or you can subscribe and be a member. And you can also follow me on Twitter. There is a link below in the description of this video. Thanks a lot, everybody. Stay safe. Have a fantastic weekend.